In this video, we'll talk about the rule of three, which basically says you should not enter a trade unless you have three reasons that that trade is going to go in your favor. And I believe you should develop a trading system that actually follows the rule of three, and three is actually the minimum. In this video, I'll share with you some of the ways that I use the rule of three, and I'd call it the rule of three plus, to enter my own trades, and how you can adopt this in your own trading system to have an edge on the market. I've heard this talked about in other places, the rule of three, and usually it's talked about in the realm of you should have three indicators that you look at that give you a positive sign to enter the market. I think that's probably a helpful way to look at it. I would say if you want to be a really good trader, you have to have a more sophisticated way of looking at the rule of three. And the rule of three should be looked at as in you have indicators in one bucket, you have price action in another bucket, and then you have technical analysis in another bucket. Now, I know many people might be saying, well, wait, you have these indicators on your chart right here. You have the RSI, you have the rate of change, you have the MFL, which is really the MFI. You have that on your chart. Isn't that technical analysis? And here's the distinction that I would suggest that you start employing into your own trading system. Technical analysis is, and we're looking at right here, we're looking at basic attention token on Bitcoin on the daily time frame. I'll go over a trade I did here, but I would consider technical analysis as you're looking at trend lines. One of the things that I use in my own trading system that I teach in my training is value channels, because they're a highly effective way to trade. So you'll see here I just quickly drew a value channel for BAT. So I would put that in the realm of technical analysis. You're looking at the historical pattern of where price action has been, and you're looking at support and resistance levels. You're using some type of charting system it could be Fibonacci, it could be whatever you're using, but these actually are one of the reasons why you would enter the trade, because it's at a certain level, it's hitting a certain level, or it's doing what you would expect on however you're developing a charting system. The other important thing to keep in mind here with technical analysis is that it is historical. This is all historical information. You're assuming at some point in time that the market is actually looking at this information or is going to behave off this information. But you have to also keep in mind that that's all historical. And that leads into my next point about indicators. There are very few indicators that are predictive, meaning that they're going to predict what's going to happen in the future. The actual Ichimoku is one of those that actually does look to predict the future, but the RSI, the MACD, the MFI, these are not predictive actual indicators. They are indicators that tell you historically where things have been, and they're lagging, meaning that they're lagging on the data that's coming over in the market. Oftentimes, by the time that an indicator paints the information that you would want to know, you've missed the trade, or you've missed the best opportunity for that trade. The other thing is that indicators, like the RSI for instance, this is sometimes ignored within a highly volatile market like the crypto market. So in markets that are not as liquid, indicators work differently than they do in highly liquid markets like oil or something else. I'm laying all the groundwork here. We'll get into more details here as we move forward. And the third thing is price action. When we talk about price action, the way that I suggest you look at price action is that's real time. If we go to the 15-minute time frame on BAT, this would be potentially another one of my reasons, but this is price action. This also does keep in mind the historical aspect of what I'm seeing on the chart, because this reveals the emotions of this market right here. Everything that I see here is the greed and fear of the market in a chart form. But when I talk about price action, I'm correlating what's happening here, what has happened here, with what's happening in real time, and whether or not that confirms what I'm seeing on indicators or what I'm seeing in my technical analysis. So when we say the rule of three, like I said before, it usually is talked about as indicators. I like to say that your rule of three at a minimum should have one reason from these three buckets for you to enter the trade. And that's why the rule of three really is a minimum. Typically, when I do a trade, my rule of three is really a rule of six. I have 6 different reasons that I see within the chart, within the trade, that shows me that this is a trade that will potentially go in my favor. A lot of times, even with my rule of 6 or 7, trades go against me because that's the market. So just understanding that just because you have a rule of 6 or 7 doesn't really mean that the trade's going to go in your favor. But with the proper risk-reward profile, you'll have a lot more winners, and you'll have a trading system that will give you a huge edge on the market. The most important thing about the rule of three is that you're following a system that gives you discipline. And a lot of traders, they don't follow a system that gives them discipline. If you develop a rule of three model, like I'm suggesting here, and a rule of three that goes beyond just indicators, and that has 3 different reasons within these 3 different buckets, you're developing a trading system that touches all the aspects of the information available to you in the market. And the bottom line is, look, I'm not putting together videos to just make you a typical trader, an average trader, an okay trader. I put together videos so that you'll become an exceptional trader. That's really my goal. My goal is to become an exceptional trader, one of the best traders in the world. So when I put together stuff, it's really about getting to that level. It's not just the simplistic view of the market. And to just have a rule of three that only looks at 3 indicators is a very simplistic view of the market and will not give you a big enough edge. So let's jump over to a couple trade examples and talk about how you can implement the rule of three. And just, if you could just indulge me for one more tangent. While what I mentioned here is the rule of three and it's going to talk about other indicators, I trade a little bit differently. And the reason for this is that I'm fortunate enough to trade every single day, and I have a passion for trading. I have a passion for watching the market. I have a passion for actually trying to figure out the market and understanding that I'm never going to be able to figure out the market. But I'm passionate about that. I actually enjoy it. So I found something that I'm very passionate about. So a lot of times in my Discord group, you might see I do a trade and you might not be able to figure out how I'm using or what 3 reasons or what reasons I have for entering the trade. It's because I've developed my edge on understanding the emotion of the market and doing a trade that isn't necessarily looking at these indicators that I'll mention here. But one of the things that does frustrate me about watching other YouTube videos or other trainers is that they assume, or a lot of them assume, that you're like them. I don't assume, not in a good or bad way, but I don't assume you're like me in any way, shape, or form. So when I put together videos here on YouTube or in my training is developed in such a way that you're not like me at all, but here's the foundation understanding of what we're going to cover here. That's why it's probably obvious, but I just share that because while these trades that I enter do correlate with some of these things, I didn't look at the RSI on some of these things because the way that I read the market already takes into account that information that's represented within the RSI. I just mentioned that just because I have to be upfront. I can't, I'm not going to share that, hey, this thing paints this way and that's the reason why I entered the trade when that wasn't the reason why I entered that trade. I just share this just to have complete transparency on how I trade and the reality of how this works. That being said, I believe beyond a doubt that you can develop a trading system that will give you an edge on the market using the rule of three and these 3 buckets and indicators. Because what these indicators paint is the same thing that I'm reading from the market, the same emotion from the market. Just keep in mind some of it's lagging. So that's one thing to keep in mind. But let's jump into a couple trades and talk about how you can use the rule of three and how you should be using the rule of three in your trading. Now here on this trade here that I did a bat, I actually did take an exit here recently, at least half of the position on BAT. And it probably still has some more room to go based on the sentiment of this project, but I like to take profits. So on 6/13, actually, I entered a trade on BAT, and this showed that it was actually approaching a value channel. Now, all this price action that has happened from here, this wasn't here, obviously. So I was just going off of this value channel that is here on the chart. It was a similar one, so you did see that I redrew it, but it was a similar value channel. And one of the recent videos that I did on YouTube here was actually talking about what happens when price hits a value channel area here in these supply and demand zones. So based on my charting pattern, I knew that there was a supply and demand zone going to hit here, and I should look for confirming price action. So if we go to the 4-hour time frame here and we go back to 6/13, this would be one of my checks. So one of my reasons for entering the trade was a value channel supply and demand zone. So here's a value channel supply and demand zone, and this is where we're going to go back in historical data and make ourselves look smart, obviously. But I did enter a trade here. So what you'll notice is that there is stopping volume here. This is something that I talk about on the channel here. I talk about quite a bit of my training, but there's stopping volume, and then there's confirmation that follows through. So there was stopping volume right around a supply and demand zone. We see that very clearly here on the 4-hour. On the 4-hour, there is a confirmation multiple times, and if I actually pull out an arrow, that it was starting to slow down here. It slowed down, looked like it might actually stop, but then it continued to slow down, or it continued down, and then it started to get rejected more and more on the downside, and heavy rejection here. So heavy rejection here. So this is about where I entered the trade on this time frame here. Once I got confirmation that this supply and demand zone was going to be controlled by the buyers. So that's when I entered this trade here. And then I actually added to my position as it further broke out here and added to my full position as it hit this next supply and demand zone here. And I did take a chance and say, well, if it does get rejected, I'll get out of this trade if it breaks down from this supply and demand zone here. And it actually just continued right through it. So I was in my full position after it broke through here. Now, how you would look at this is that would be one reason. So this supply and demand zone here, this is a reason. This whole price action around here and how price unfolds and what happens is one of your reasons to enter a trade. So that's one of my reasons. Another reason that you would look at here, and this is if you know about the RSI, I'm not going to go into detail about what the RSI is and how to read it. Just understand that the RSI here is below the 20 mark. This shows you that this is a good position potentially. Now this is the SRSI. So basically it has the moving averages on here, and you see that it crosses here. So it crossed here. This is another reason why you would potentially enter the trade, is because it crossed and it's on its way upward. So this would be another reason. If you're using indicators, which I think is good to use, but if you're using indicators, that would be another reason to enter this trade. At this point in time, it was below 20. Now, the other reason that you could potentially use is we see a crossover in moving averages here. So, and I'm going quick because the goal here is not to actually explain to you all the reasons that you should have to do trades, is to give you examples of how you would have multiple reasons. So a little bit later in this trade, as it unfolded, we see that the yellow line here, which is this line here, is the 10 moving average. This purple line is the actual 21 moving average. We see the yellow crosses the 21. So this might have been another confirmation that you were still in that trade, or another reason to maybe add to that trade. Once again, I didn't use those indicators because I'm reading the market in a different way, but this would be another reason or another check that you would use to actually enter this trade. Another thing that you would look for on moving averages, just so that I can discuss this, is that on a faster moving average, meaning a smaller, like an EMA 5 or an EMA or an MA10, you're looking for those to turn. You're looking for those to turn up, and sometimes you're looking for those on actual lower time frames. So on a lower time frame, and I got to go back in time, which is very frustrating. I don't know why it didn't show me where I was at. On a lower time frame here, you're looking for that change, that swoop upwards of a moving average. That would be another reason. Once again, you need 3 reasons to enter a trade. So my first reason would be technical analysis related and price action. So technical analysis says that this is a supply and demand zone, and I expect heavy rejection to go long in a supply and demand zone. And then the other reason is that price action confirms that, and price action did confirm that. I could even look at a lower time frame. I should be looking at multiple time frames, so not just on the 1 hour. I should look on the 15-minute, what's happening on the 15-minute. Why does it keep doing that? Yeah, this is really frustrating. So, and then looking at the 15-minute and seeing what's happening, I'm going to go back to the 1 hour just so that we can, and I apologize that the chart is bouncing all over here. But you should be going to multiple time frames and using empathy in your trade, looking at the market from multiple time frames, multiple angles to confirm the price action that you're seeing. I'll do a separate video on using empathy here going forward, but that's what you should be doing. So when you're looking at price action, it's just not one individual time frame, it's price action on multiple time frames. So one of your reasons could be if you're using Fibonacci or you're using value channels, that it hit a supply and demand zone, it was rejected at a supply and demand zone, and you have confirmation price action. Another reason could be the moving average starts turning up, and then eventually you have confirmation because they actually are crossing or they're getting closer together. Another confirmation that you can use as we go back to the 4 hour here and we scroll in is an oscillator like the RSI. You could use the MFI, for instance, and you could say, well, here at the MFI was well below 20 as well. So the MFI was at the lower range. Once again, I'm not going to talk about these actual indicators. Another indicator you could use is basically the momentum of the rate of change. So the rate of change, why I have this on the actual chart, if you look at this, this is the rate of change. You can get a feel, if you use an indicator like the rate of change, of how is the market moving based on change, based on percentage change. So this day here was a 17% change. This day here was a 16% change. Well, with this rate of change, if you get used to using it, and if you actually do use it, you can get a general feel of the momentum of the rate of change. It's the same information that you're getting from the chart, only it's broken down in a different way. So the rate of change is another good indicator. Now, with all this indicator talk, I don't want this to be lost. Once again, we're talking about the rule of 3 and that you should have 3 reasons to enter the trade. So and it's a minimum of 3 reasons. So you need to develop a trading system, if you have not yet, a trading system that has at least 3 reasons that would give you an indication that that trade will go in your favor. And that 3 reasons I suggest should come from these 3 buckets. And all this talk with indicators, you can get overwhelmed and actually say, well, I should have 3 indicators that tell me to enter the trade. Well, if the 3 indicators really measure close to the same thing, then they're really not a reason. They're one reason. So that's something to keep in mind. If you're using 3 moving averages to tell you to enter a trade, that's only one reason to enter that trade. Or if you're using the RSI or the SRSI, it's kind of reading the same thing. It's a little bit different setup, but it's kind of the same reason. So when you're looking at developing your 3 reasons to enter a trade or your trade system, ensure that these 3 reasons give you an edge on the market, and there are 3 reasons that come from these disparate buckets that give you an edge. That's what I would suggest you develop in your system. So when we look at another trade that I did recently, or actually I'm looking to enter BAT again, and it's at that same level again. You can just see that. That's why I took an exit here. I'll just share with you. This is just a general rule of thumb in crypto. Actually, my exit was over here. Anytime something in crypto typically moves 30%, So this moved 30%. There typically is a retracement. Very seldom does a 30% move hold up for any length of time. So we see here on BAT, it moved from this range. You could even use this range, but from this range, you could say from this is the overall range. So if we use this as the resistance range in air quotes, that's not quite a 30% move, but it's pretty close. It did touch 30%. Well, it touched 30%. You should immediately be looking for confirmation that it's going to retrace back. And what did it do? Is it retraced back. So when it moves 30% again, what did it do? It did touch there. Now it was highly rejected within the same 4-hour period. Well, it's been rejected again. So what are we doing right now? I have entered trades on this. I shared this in Discord. Once again, I followed 3 separate rules. And let's just look at the trade right now, actually. And let's see if it follows some of our rules. If we just use rudimentary knowledge of indicators. Let's just use rudimentary knowledge. So right now, it's approaching, once again, a supply and demand zone. And I think I've used BAT for a couple different examples here. So I should start using other examples of trades I've done. But this is, if the market presents a good trade, why not do it? So we've seen that it's approaching a supply and demand zone. It's been rejected already, and it's starting to maybe tighten in price. We'd like to see an additional rejection of this range here. We might not get that opportunity. Keep in mind, this moved within a 4-hour time frame. If we go to the 2-hour time frame, we'll see that move was in 2 hours. So that was a big move in 2 hours. We didn't have time to catch that, but that would have been a nice swing trade. So I would suggest, and I've already done this, so I'm not suggesting it, and I'm not suggesting you trade. So this is not a trade suggestion. I'm not a financial advisor, but I'm suggesting to myself that I enter a trade here for a swing trade, and potentially maybe I exit at 21%. That's what I'm suggesting to myself. So I've entered my first position here, and then I'm looking to see whether or not this supply and demand zone will hold up. It might break. If it does break, I'll be looking at this next one here as well and seeing if that one's going to hold up. I might add to that position if I still think that there's strength here, and I would have been down 7%, still fits the risk reward of this actual target trade, but then I'd be getting a little concerned if this actual supply and demand zone breaks down. So that's my first rule. I'm looking at price action here. So far, this price action looks to be some rejection to the downside. There's indecision in the market right now. We're seeing indecision in price. So the buyers and sellers are kind of arguing whether or not it's worth this value, whether or not it still needs to retrace down more. But there is some good rejection to the downside. And I would suggest, based on how I'm seeing price action develop right now, is that I entered my position a little too early. And one thing I will mention is that I do this. This is the way I trade. I like to enter maybe a small position where I see the first amount of rejection, which would be right around this area. So I'd enter a small position here. And I do this because I found that if I'm not actively watching the chart, or I don't actively have a position in something, that I don't watch it the same way. And it's something I'm working on as a trader, is to have complete detachment from a position regardless if I'm in it or not. But I actually watch a position differently if I'm in it. So even if it's a small position, because I don't look at the dollar number, I'm looking at really just the percentage that I'm looking to make. Just the best way to trade is just don't think about dollars. Don't think about the capital at risk. Have proper capital controls, but trade trades. Trade trades that are good trades. Always focus on the trade in front of you or the next trade. Don't think about the last trade, and trade good trades. Part of good trades is to have 3 reasons to enter the trade. So my first alignment here happened here, but it's a small position. Now I'm watching this position. So now as I watch it unfold here, we're looking for maybe additional confirmations. And this is if you don't have the skill level of where I'm at, then you want to develop a trading system with additional rules that give you an edge. So an additional rule might come into play. Let's look at the RSI. Let's put the standard RSI on this chart here. Let's go RSI. And let's just do the standard RSI. So the RSI is right around it's not at the low end, it's not at the high end, and this is on the 4-hour time frame. It's kind of leveled out. Now that can mean one of two things, and we're seeing that play out in price action. There's no actual move upward. There's no move downward. I do anticipate it's going to retrace back a little bit here, maybe retest this supply and demand zone here again. So this would not give us a reason. This indicator, using this indicator, I don't see it as a reason to actually enter this trade. So you don't have a reason there. That's the way to use these actual, when you're looking at creating 3 reasons to enter a trade, you're developing your system around indicators, price action, technical analysis, and you should have 3 reasons that confirm that this trade is going to go in your favor. Right now, this indicator is indecisive. Based on reading this indicator, it's very indecisive. Doesn't tell me one way or the other. Same with the moving averages. All the moving averages on the 4-hour, they're all painting down. They're continuing downwards. Now, the thing with moving averages is, of course, it's trailing. It's based on the actual historical aspect, and it doesn't start turning until price has really moved. You can use an EMA, which would mean that it would take recent price action more into account, but even the 5 EMA here, so the green here is the 5 EMA, that is still pointing down. It's actually not, it might be leveling out. So depending on how you trade, there probably isn't enough indicators here right now in this trade for the average trader that is just building a trading system to enter this trade yet. This, based on what I see here, with just limited indicators, limited price action, everything else, you don't have 3 reasons to enter this trade right now. I've entered a position. Once again, I trade differently. I'm reading the market differently. Part of it, I need to be invested in a trade sometimes for me to find really good trades. So I've already entered a really small position, and then as it moves, as I get an alert that, hey, this thing moved, and it's usually 1 or 2%, then I would add my full position, and then I would add my full position either on a retest or a breakout, and then I would look for the same exit. I'd probably do right around 19%. I just like to be out before everybody else would be out. And the other thing I'd mention, and as we see here, the 4-hour is starting to have some rejection there. So the 1-hour probably is, it's hitting consolidation, or what you could consider consolidation. You should be looking at multiple time frames. So I just looked at a couple time frames here. Once again, this video is not designed to give you the end-all be-all of the 3 rules you should have. I'm actually, and this is something I'm going to put in my training, I figured out that I can distill my trading system into a series of rules that would give you 3+ rules based on indicators and everything else. So in my training now, I'm going to develop a trading system based on how I trade, but then correlating it back to how you can read indicators. So that's something I'm adding to my training now. I first resisted it just because I didn't feel it was possible to do a foundational level training with that. But as I've mapped it out and as I really designed it, I realize it's actually possible for someone to then take that foundation and adopt it to themselves. So that's what I'll be adding to my training. That's the next phase of my training that I'm really excited about adding here. And that should be out here shortly in the next couple weeks. So I'll release a video at a time, but I've already got it mapped out and I'm really excited about it. So back to the 3 rules though. And I'm going to cut this here because we're approaching 30 minutes. I really thought that I'd be able to knock this out in 15, but as I can see here, we're at 30 minutes, or we're about to hit 30 minutes. I'm looking at confirmation on multiple time frames. I'm using these indicators at multiple time frames. So that's where that rule of 3 could really turn into like 6 or 7, 8 or 9, is that these indicators are showing you positive signs. Price action is showing you positive signs. Moving averages are showing you positive signs. Value channels are showing you positive signs on multiple time frames. So then you might have, okay, on the 1-hour, I have one reason to enter the trade. I see rejection. On the 4-hour, I see rejection, for instance. I see good price action, good behavior that I would expect reaching a value channel, supply and demand zone. And then on multiple time frames, even the daily, you would maybe look at the daily and say, okay, well, the daily here, you would look at this as well, and you would say, what does the daily look like? I'm even trading off the weekly on a lot of these things. So you look at the weekly and you say, well, what does the weekly look like? So when you're entering a trade, even a swing trade, I'm looking at multiple time frames. I'm looking for as many reasons that I should do that trade. And actually, I probably should have started this in the video, which is like, you shouldn't always be looking for a reason to do a trade. You should be looking for a reason why you shouldn't be doing a trade to protect your capital. So the converse is that, yes, you should have at least 3 reasons to do a trade, but you should always be on the lookout for reasons not to do the trade. So oftentimes, I might look at something on a lower time frame, and then I look at the daily, and then the daily shows me that it's at the top of a range, and that's where I go, well, this is a little bit more risky because it's at the top of a daily range, and these confirmations that I got from maybe indicators or anything else on a daily chart, it looks more risky and it's not worth the trade. So that's why you should be looking at multiple time frames. You should be looking at these rules that you create, different dynamics to each one of the rules. And a good way to explain this is, let's look at another chart. I think Zen BTC is moving today. And if we look at the chart here, we'll see the daily moved quite a bit. So if you're fixated on a hourly chart, and this hour is just obvious, I mean, it just moved so much here, you're expecting a retracement. It moved 30%. What's my general rule in crypto? When something moves 30%, you expect a retrace. We could go chart by chart and just show that it will retrace down to here. So at least down to here. It usually tries to retrace down to the mean, is typically what it does, which is the mean price of where something's at. So my expectation is that it might still have a little bit more room to grow. But when you look at this, that's a big move. And you might actually look to play the first retracement, which actually already happened. So basically your best retracement move already happened. So you missed this trade twice is the way to look at it. And I'm just reading price action. So this is just one of my rules. Just based on the hourly, I missed this trade twice. I missed it here, down here. That was the best trade, or in this range was the best trade. And then I missed it here, which was the first retrace. So this is the first negative retrace, negative hour, close, retrace here, which then retrace down even more, which is the retest. So these, statistically, this pattern that you see here on the 1 hour works out pretty well if you catch them at the right places. And we've missed this trade twice. So I don't have a reason to enter this trade. And if we look at the RSI on the 1 hour, it's at the top range, even though crypto likes to ignore that. So sometimes it might stay there for a while. But you have a lot of reasons not to enter this trade. So just like you're looking for 3 reasons to enter the trade, when you start seeing more reasons that you shouldn't enter the trade, this should work just as the same way as reasons to enter the trade. But when you're looking to enter the trade, you need to have at least 3 reasons from these disparate buckets. And these should be in your trading system, meaning that they're just not, you just don't look at these on the whim. You just don't sometimes look at the RSI, don't look at the MFI, don't look at the percent change bar or the rate of change or the moving average. These should be in a checklist. It's kind of like if you're a pilot and you're going to get in a plane, you have a checklist that you actually check, a pre-flight checklist that you're going to go through. You want to do the same thing with your trades. That way nothing's left to chance. That way you're not going to forget something. That way you're not going to look at something. Now, what can those things be? I have another video, and that's contained in my training. I cover these indicators, and I cover what these things are and how to read this stuff. But you need to choose what these things are. You need to choose which one of these indicators you're going to invest time to understand, to watch, to read, to use in your own trading system. That's what you need to develop. All of these indicators are great. I'd say price action, at a minimum, you need to have. Some type of charting aspect, technical aspect you need to have. Whether or not you use Fibonacci, you use value channels, you use something else, you need to have. Indicators. It's good to use indicators. It's just a matter of you have to choose which one you want to invest time and effort into mastering. That's the key. And then on top of that, there should be at least 3 reasons for you to enter any particular trade. It doesn't matter what trade it is. If it's a quick scalp, if it's a quick swing, if it's a longer term trade, there should be 3 reasons. And I will say, just to end on something, that trade could be news. It could be some fundamentals. It could be something you learn about the marketplace or about a project or about something that gives you reason that that actual trade will go in your favor. But it should be backed up with additional reasons as well. So it just can't be news alone. It should be additional reasons as well. So as we end here, let's just recap. You should have no less than 3 reasons to enter a trade. These 3 reasons should be from disparate buckets of technical analysis, indicators, and price action. And you should put these into some form of system that you follow to ensure that you can track that you're actually right, or that you have an edge on the market, and that you don't forget about something, so that it's just a systematic approach. It's a disciplined approach to your trading. That's really key. So that's, in recap, how you use the 3 rule of trading. Let's call it the 3+ rule of trading. Down below, you'll see a link to various tools that I use, a link to the Discord group. So definitely, if you're new to the channel here, subscribe and join us there on the Discord group. You also find a link to a document that I put together, which is the primer on trading cryptos. So check that out as well. I look forward to seeing you in the next video.